Welcome. This is the War Room for May 2014. Welcome to the Hidden Levers War Room. My name is Raj. I'm here with Praveen, my colleague and co-founder of Hidden Levers, the best portfolio stress testing toolkit known to man. War Room, we get to do mentor coaching, give you a product update, scenario updates. This presentation deck, which gets better and better, is yours to keep. You can generate ideas, and of course you can ask questions. Today we'll be discussing gold as we head into the dog days of summer. First a market update, then kind of a refresh on the gold scenarios we have in-house since we're pricing in the gold crash we had. A little bit of 101 on the gold market, supply, demand, etc. And then giving the macro picture with special concentration on India and China and the change in those countries. Okay, so first a market update. Had a few things happen in the past month, none of them really American related. There are some more tensions growing between U.S. and China. It's a funny thing because they're more and more like us. We watch Big Bang Theory, they watch Big Bang Theory, but they're not allowed to by the government, so they watch it illegally. We're also arresting Chinese military in America, 5 so far, based on this hacking stuff. And so there's a lot of tension there. I mean, it's not going to be World War III anytime soon, but you know, the world's powers are butting heads, and so that's always a little cause for concern down the line. Eventually, China is going to overcome us in terms of GDP. So as that happens, you know, will their military might be more flexed? Will it be like a Cold War like the 80s? World Cup is upon us, and so, you know, if I was looking out for black swans, I'd be looking for crazy people in Brazil trying to make themselves heard. And you know, if anything could affect markets from this kind of endless kind of pump up, it would be something like an uprising similar to the Arab Spring, or similar to what happened in Brazil last year, right now, right while the world's watching. And so, you know, we already know it's a complete. They've really mishandled things in terms of infrastructure, so there'll be a lot of people there frustrated in Brazil, but it could be ripe for a kind of Sarajevo type moment, a la World War II. We had a lot of changes in the emerging markets in terms of regimes. We've had a new government in India. Looks like the markets reacted positively toward that, and a new kind of military government in Thailand, and the markets in the U.S. don't care. My colleague Steve will be the first to tell you they've had about 19 military coups in Thailand. The Thai baht is pretty steady through all that. There was an Asian crisis where it went down in value, but nothing to do with military regimes in Thailand. That's kind of just a recycled story, and American markets don't care. And a much bigger story is deflation globally. We started covering that last month, but EU, there's high signs of deflation, especially in CPI data coming out of Belgium, etc. And so, you know, the markets here are reacting well to that. And the idea is that, well, as our QE ends, maybe there can be another round or two of quantitative easing in Europe, and we can feed off that teat for a few years. So, you know, the idea is another round of QE, nothing to do with the U.S., but definitely helps U.S. markets pump up. But the idea there is deflation.
Right, and actually the market rally this week, for those of you who may have been watching on Monday, obviously the S&P is now up 5 of the last 6 days, and sparked in part by the whispers that coming next week that the European Central Bank is going to start introducing some QE-type measures because of their concerns around deflation. So we're already starting to see the effects of this maybe in the markets with the endless bull, one more injection of steroids. All right, well, moving to the macro snapshot and taking a look at current conditions from more of a chart perspective, picking up on where Raj had mentioned BRICS regime change and the fact that the government in India has changed with recent elections, and the government in Thailand has changed with the recent coup. We thought we would compare those currencies since the beginning of the year to the U.S. dollar, to the U.S. dollar index. And so that's what we see in the top left chart here. The blue line would be the value of the U.S. dollar index, so against a basket of other currencies. It's pretty much flat for the year, up just fractionally. The yellow line there is the Thai baht. And what we actually see, if you just look at the blue and yellow lines, you see they're trading pretty much inversely. So as the dollar is weaker, the Thai baht is stronger and vice versa, but they're meeting essentially at 0% change for the year, with almost half the year done. And so what that tells you is that, as Raj was mentioning, that the coup in Thailand, nobody really cared about. Now, as far as the rupee, and if I had gone back further on the Indian rupee there, the green line, you would see that it actually crashed or really cratered. In fact, we covered this late last year when we were talking about BRICS last. But their currency had crashed into last summer and has been rebounding steadily. And with the recent election, that's the spike up here and the continuing rise. So being up 5% on a year-to-date basis is pretty impressive for a currency, not an equity or other type of more traditionally invested assets. So definitely a sharp move northward for the rupee there, and that's the optimism around the new government. In terms of the other three charts, I thought we would take a look at some different domestic indicators and what's going on. Some of this might shed some light on the bull market, and you see that we've got some fun clip art there showing signs of strength. So the first one at top right is the S&P 500 versus the 10-year. And, we've had this bull market going now since March of 2009, so we're past 5 years into our sixth year now. The interesting thing in this chart, this is looking at the 10-year Treasury yield versus the S&P over the last 2 years, and you can see that positive correlation for most of the time frame, a generally positive correlation between the level on the S&P as it rose from 1,300 to 1,900, between that level and yields. So yields have been rising. And then starting really mid-Jan of this year, they started to break apart. So initially in the early part of the year where we had that swoon in Jan into early Feb, we see that yields and the market came down together. But then they broke apart here at the end, and the market keeps on rising, and yields are now back down below 2.5%. So typically we would think of that as being defensive. Folks are fleeing towards treasuries, and therefore the stock market shouldn't be rising every day, right? Well, we have a divergence here, and then the question becomes, okay, who's right? Which brings me to the last two charts. Bottom left, we have the VIX and the S&P 500. The blue line is the VIX. The green line is familiar to you. That's the S&P and its endless march. We can see, over 10 years here, so we can see a larger perspective on it. But the blue line, that's the VIX, of course, popping every time the S&P falls. And here, with this endless bull market that we've had lately, this run-up, the VIX is down in the 11 handle now, heading towards, a 10, which, if we look back in time, we see that the lows at the peak of the previous bull market cycle was right around 10. And so we're heading right back down to that level. Now, is that to say that, okay, that means the market's going to crash tomorrow? Well, no, because if we look at the previous market cycle, just as an example, we see that it kind of skittered along at those low levels for a while, even as the market began to increase, and then started to take off as the market became weaker. So,
but 3 years of that kind of complacency is what led to, that spike. So it wasn't necessarily healthy in those 3 years, those mid-2000s years.
Well, absolutely. So, it shows that this is sort of it's just another sign of perhaps the beginning of the end. So we look at this point, and then another point that reinforces that. Let's look at the green line here on the bottom right chart, which is jobless claims. So that's initial jobless claims, the number that you hear about every week on every Thursday morning. We got another one this morning. And then the blue number would be the unemployment rate that everyone is familiar with. So I took this on a long cycle. So this is going back into the 60s. And the reason I did that was I wanted to look at multiple cycles and look at how long is each cycle, sort of from peak to trough. Because, we had the peak, of course, of unemployment and of jobless claims in early 2009, and they've been falling steadily ever since, along with this bull market. So when does this flatten out and start to go in the other direction? Because that would indicate, similarly to if we look, for instance, at the 90s, we see this peak in the early 90s, and then we see a 7-year drop, which coincides perfectly with the bull market of that era. And then we see it rise with that recession and when the NASDAQ bubble popped, and then we see it come back down again. So this corresponds very well with peaks and troughs in the equities market as well. Maybe not surprisingly, because these are good barometers of the economy. How many people are filing unemployment claims and are unemployed? Anyway, so when you look at this and you kind of look at the measurement of these cycle lengths, you see the longer cycles are somewhere in the 6, maybe 7-year range, and some of the shorter cycles can even be just a couple of years long. So we're currently over 5 years and counting. So another sign reinforcing, what the VIX is saying, which is that we're closer to the end than to the beginning. If past market cycles going all the way back to the 60s are any indication.
A point before we're done here, you can see the new kind of emoji idea on the charts. I mean, what we have this idea at HiddenLevers, besides the hardcore economic analysis and stress testing, is whatever's client-facing, make sure you're doing something for the millennials, the children of your retiree audience or the people that are going to inherit that wealth. We know industry-wide the statistic is pretty damning toward advisors. It's 2% retention when the wealth transfers between generations. And so, you may find it silly to use emoji in a financial chart, but obviously whatever you're doing now as an industry, as advisors, is only retaining 2% of that younger audience retaining that wealth. And so that is the biggest generational wealth transfer in history coming between boomers and millennials. So we're trying what we can to do something different, maybe speak their language, and so look at us as a resource to do that. Speak a language. We're already trying to make economics or portfolio stress testing really simple, but to then speak the language of the inheritors of that wealth will only help you retain them. Okay, Let's move on.
All right, let's jump into talking about the scenarios a little bit now, and review first where we were in terms of the historical scenario. And Raj, if you want to describe where we were in 2011 with our first presentation on gold.
Well, this is showing our shame and our success at the same time, which is awesome. If you look at where we were, as macro traders with a background in this stuff, we were very bearish on gold from that first August 2011 webinar. It's one of our first war rooms, actually. You can see the slide and how awful it is. It's nothing like the work we produce today. So, at that time it was just starting. So you've seen the startup grow. But in terms of the call, we really talked about a gold crash amidst an uptrend and what that would look like. And so as we were hitting 1900 and you had a lot of bulls on gold breaking through 2000, we were comparing it to oil in 2008, 2009. Saying that same kind of mania was there, and that's the time to get out. We noticed the S&P definitely rising, and so money would come from gold and transfer into equities because there's a different kind of yield there, and just what we're more used to. Gold is a safety play, and so because we had at that time we had to make a distinction between our own opinion, which was heavily bearish on gold, and being comprehensive that there are other opinions. That really started our ethos of assessing risk parity, showing good, bad, and ugly in most situations, and then of course some historical analogies. So that whole risk parity mentality started then. If there are other risk technology tools out there, even at your price below us, priced above us, but no one really does that in terms of showing good, bad, and ugly, and visualizing it and verbalizing it that way. And so this was the start of that. That was a solid analogy in the end. Gold did come crashing down, similar to oil prices. Not nearly as much. I think oil was what, like.
Yeah, oil went as low as $32
down to $32. Yeah.
Right, so 80%. But as we'll see, with in a few more slides, this 33% may not represent the completion of the gold crash if prior declines in gold prices are any indication. We'll see just how far gold typically goes.
We're really at a way station, which is why we thought the stability around $1,300 an ounce is a good time to reassess. And since that gold crash is priced in now, to say, well, where do we go from here? Well, so that's where we are. We'll start with the ugliest. Is gold signaling deflation? Is it the canary in the coal mine? And so where we have that scenario, it's the drawdown would be down to $700 an ounce. You see heavy support there. We'll show that on the charts in a bit. And there's several precedents for this. To go past 40% on the max drawdown, a 40% drop after an upthing. A lot of stuff out there on the web from smart economic pundits and dumb ones too. They always talk about the 1930s where gold was actually a hedge toward deflation, and that's because there was no such thing as a fiat currency then. it was a peg between gold and the dollar. And so you had that gold standard. And so nothing like that exists now. So if you don't have a gold dollar peg, then you really can't have it as a hedge. So anybody that talks to you about analogies to the 1930s and using gold as a to beat deflation, they're just wrong. Those analogies are invalid because we're off the gold standard, and that's just the way it is. In terms of the dollar itself, needless to say, other commodities have not been lackluster. Even with Russia, Ukraine, you haven't seen oil prices going even to the Arab Spring levels of 115. It's still around just around 100. And the dollar is getting stronger everywhere you go, including Japan, including Hong Kong. In other first world countries, the dollar is getting stronger, including Europe, at $1.36. So that purchasing power rising, every day that goes up, that's gold's end. And so what does this, if we are headed toward a global deflation era, then definitely gold is not something you want to hold. The caveat is, of course, the government, if gold does go down too far, of course, we are a huge holder of gold in the U.S. China does, Japan does. So they may try to hedge that using legislation as opposed to options.
Although it's worth noting that the Treasury, or rather the Federal Reserve and the Treasury, for official government purposes, the book value of gold at the U.S. Treasury in Fort Knox and all of that is it's somewhere around $35 or $42 an ounce is actually the book value that they use, and so they've never opted to revalue it to market prices, and so maybe that reflects how much interest they really have in gold at this point, having been fully fiat for several decades.
Okay, well, so that's gold times deflation. Very much a black swan. If we get toward that would entail a huge S&P correction also because because of deflation. The bad scenario, much more likely now. We're at this pause, and the idea is that gold touches 1,000, just drifts up and down a little bit, not in a straight line, toward $1,000 an ounce. And it's a huge technical support level for gold. There's a lot of options activity around that level, and it completely fits the paradigm of past gold crashes, a proper 40% drop, even 45% drop, even 50, somewhere in that neighborhood. 40 to 50% is exactly where the sweet spot is for previous gold crashes. The Fed has made no buts about it. They see no inflation risk out there, and every Fed statement for the past few months that's been made, gold crashes on those days because they keep saying the same thing. We don't see inflation. We can do what we want. Rates are low. We can do what we want, and so because we don't have to raise interest rates, gold goes down those days.
Right, and at the same time, QE has been, at least in the U.S., they have been so far keeping to their word and slowing the pace of purchases, and
right.
And so that may have a negative impact if those investors that are in gold, presumably because they think that it's a hedge against money printing, that is kind of bearish for gold as well.
Exactly. So they are keeping true to their word. You could have there are conspiracy theories out there that the markets are telling the truth and they're still pumping money into it. They're just telling everybody that they're not. And so you could take that for what it is. But what we have from the statements of the Fed is that they're at about 45 billion now, trying to get to zero money printing by the end of the year. So, but it's only going to be less money printing. So definly as that happens.
Interestingly, even if that were true, so if that conspiracy theory is true, assume it is true for a moment, it's interesting that none or very little of it is finding its way into the gold market. So it seems to be heading mostly towards equities anyway, and so we still see the that same issue where gold is drifting downward. And gold, of course, took some of you who follow it more closely may have seen that gold took a big leg down actually earlier this week as well, so dropping like $35 in a day. So
yeah, we had a 2% decline yesterday, I think.
So
yeah, today it's red too. So at 1,000, I do expect to bounce. It's just a technical thing. So don't confuse that for a rebound. Like, oh yeah, this is a long-term investment now. We can catch the falling knife. That will catch a lot of people off.
Well, there will depend as we look at these various scenarios. It really will depend, and as we're going to see more about the fundamentals of gold on the shape of inflation, and how that goes. If we look at the top being right around 1,900 on gold, then coming down to 1,000 is very close. to that 45 to 48% number that Raj talked about. So that is very close to the historical max drawdown in a cycle. But as we'll see, it depends on if there's, if we get into an actual deflationary environment, of course, we could overshoot that target as well. But let's now talk about the positive, if we can, for a moment. What would it take to have a gold rebound? Really, what drives gold demand, and therefore, how could gold potentially go, rise? Well, first off, it's important to note, where is gold demand coming from? India and China are far and away the two largest buyers of gold, both for jewelry and in physical form for investment purposes. That means bullion, coins, bars, things of that nature. India actually was struggling with gold imports, and what the government had done there was to limit it. For most of 2013, tried to limit gold imports as a way of reducing their current accounts deficit. So essentially, too much hard currency being, I should say hard currency in this context, too many U.S. dollars, as in U.S. dollar reserves in India, were leaving the country in order to buy gold on world gold markets because Indians were, had that demand for gold, and what that was doing to the Indian rupee was it was helping drive the crash of the rupee last summer. So what did the Indian government do? They stepped in and they limited imports, which of course decreased demand, and that would be that was part of the bearish story for gold last year. That has recently been relaxed somewhat, and so we might see gold demand rise again now that the Indian citizens are able to buy gold more freely. And the price premium, it turns out that gold in India is more expensive than it is in most of the world, and the price premium will drop since less of it is smuggled gold and so on. So that's the chart at the top left, and in fact the chart at the bottom right or the bottom left as well, just showing just how much demand is really coming from China and India, and this is worth noting too. I mean, look at how small the U.S. is, with the U.S. being still a far larger economy than either of these. But Americans just don't put a lot of their investable net worth into gold, whether in jewelry form or bullion form. As much as there is a niche of gold bugs here, it's not a big deal like it is culturally embedded in China and India. So an upside surprise.
Yeah. So if you're fighting it in terms of some of your clients, in terms of leaving them in gold, or they are gold bugs, just imagine how much harder your job would be as an advisor in those other countries.
Oh yeah, where it's fundamental. So yeah, the upside surprise on demand in India or China, that is, would be one plausible reason. These concepts of an escalation with the Russia situation, Russia-Ukraine situation, or other EM chaos, while there's a certain amount of validity there, what we'll see as we look at some more data is that it's really inflation that matters at the end of the day. And so unless any of these events, and certainly events in Russia, if they were to get very serious and lead to oil, for instance, not hitting world markets, that would drive inflation and help and drive gold prices. But outside of that, it's relatively difficult. And there, of course, you have potential technical bounces being positive. In terms of what would it take, though, to drive gold back up, and actually I'll move now into the scenario comparison. What would it take to drive gold back up from where it is today in the mid 1200 range back up to 15, 16, 1700? It really takes some sustained inflation. There has to be inflation at the end of the day to cause a rally in gold. That's the one time you can honestly say that holding a hard asset like that might be a really good idea. And so that's the first of the three scenarios. We look at the good, bad, and ugly in terms of scenario comparison. The gold rebound, in our scenario, we have it projected out to around 1600, with a mild drop in the S&P as a result of rapidly rising inflation. Inflation roughly doubling from where it is today, along with the spike in interest rates, and that, of course, would also maybe put some drag on the S&P. And a slight decline in the U.S. dollar due to inflationary pressures. So if a source of inflation can be found, then, or if you or your clients, have a strong reason to believe that that's a likely scenario, then that would be a reason to have some gold exposure. In terms of the midline scenario, and this is the scenario that we think is likely, And that's based on the fact that gold historically has dropped around 40 to 50% from a peak, in terms of individual gold cycles. So if you look at 1900 as being, roughly as being the peak during this cycle for gold, then $1,000 an ounce is not at all out of the question. And we see this happening, all things being equal, within the current upcycle. The economy does continue to improve, as we looked at the macro snapshot earlier, and we saw that jobless claims and things like that do continue to fall. And so, this scenario has projected out the S&P rising by mid-single digits or rather high single digits over the coming year, with rates and CPI, other factors relatively in check, but gold losing, even having lost as much as it did, losing another 18 to 20% as it moves down toward 1,000. And then we have the ugly scenario, which is ugly across the board, meaning it's not just ugly for gold, but ugly for equities, investments as well. This is a scenario in which gold crashing is basically the canary. So the gold canary we have, there's the gold canary in the coal mine of the warning sign that we are moving into.
The canary in the gold mine.
Yeah, the canary in the gold mine. There you go. Do gold mines have fumes? I don't know. So the canary in the gold mine of CPI falling significantly to dangerous levels, and causing an equities correction and a gold correction as well.
Yeah. So the main thing is drift to 1K. S&P, that movement is neither here nor there, 10% and likely upward.
Right.
Whereas the deflation, as a signal of deflation, it's both of them coming down together.
Yeah, and so we had a question on, based on the scenarios, is there a way to do a probability analysis to determine which scenario is most likely? Good question. We have not built that in because, of course, well, if we could tell you with certainty which scenario was going to occur, then hey, we'd just play that trade, wouldn't we? I can tell you that, as we're about to see in the next section, why we think the decline has a bit more to go, but we don't assign them individual probabilities.
I think touching, in terms of our own macro calls, aside from the software, gold 1,000 will be touched. That's what we think in the next 12 months, probably.
That seems like, even time frame aside, it seems like, and actually we're moving into that section now, so I'll address it. But that's where we feel gold could go before really having a sustained bounce back. All right, so let's move now into Gold 101, a section where we're going to talk a little bit more about gold fundamentals. Here, I just wanted to touch on gold as it relates to other commodities and talk about gold demand a little bit as well. So gold versus silver, since many who are invested in precious metals sometimes allocate between the two. And for those who are doing that, we just wanted to note how closely correlated they are. This is over the last 2 years with gold prices on the left and silver at right. The correlation is very close to 1. I mean, you can see it's almost perfect tracking. Now, as the sort of astute among you may know, correlation does not imply the magnitude. That just means that they're moving together. In terms of the magnitude of the moves, look at this. Look at the axes, and you'll see that as gold goes from 1,500 down to 1,200, so a drop of like 20%, silver is actually going from something closer to 30 down to 20. So it's moving more like a third. And so silver does move faster than gold on a percentage basis, and it tends to be more volatile. But at the same time, it tends to move in the same direction as gold. So as we've said, I think in the past when we've covered this topic, if you are interested in gold, whether on the long side or the short side, silver is going to give you a very similar, if not the same, investment based on the correlation, just with 1.5 to 2 times the volatility.
Why don't you go show that in the toolkit so they can see there's a good benefit. You can chart things on 1 scale or 2, so it's really handy. This showcases why.
Right. So if I go into HiddenLevers and we look at the economic data center, I can go, or rather into data center charting, I can go in and pull up a chart here, and what I'm going to do is, why don't we chart gold and silver, just to show, and this by the way is how we produce many of the charts that you see in the presentation. So let's chart gold versus silver, and let's not plot them on separate scales. So here we can get a sense for, on a percentage basis, you can see the green line there is silver, and you can see immediately they are moving together, but look how explosive silver is on a percentage basis versus gold. Let me take that down to the time frame that we actually looked at, the 2-year time frame. So in each case, look at those pops on silver whenever gold was moving up, and then look at the downside on silver when gold was moving down. So you get...
Yeah, the volatility is much more on silver. That's easy to see that. So now try and plot them on 2 scales so we can see the chart we made.
Sure. Just had a question here. How would you account for silver when it's used in manufacturing versus as a hedge for inflation? Would you see it as representative as a key indicator for growth? I wouldn't, just based on, even if I were just to look at the charts that we're looking at now, which is the, let me re-render that real quick. So this is the chart that we actually showed. So just looking again at the fact that despite the fact that silver does have industrial uses, and let's bear in mind gold does have industrial uses as well, 7 to 8% of gold demand worldwide is actually for industrial purposes, chiefly technology. Because it is a great
medical
conductor.
Instruments.
Yeah, it's a great conductor. So it does have some industrial use, and silver, of course, has industrial use. But at the end of the day, we see that silver prices rather just track gold so closely that we can do nothing but conclude that it is just a more volatile proxy for gold. That's what we see in the data.
And you're looking. I remember on the street, people would be looking for that 10% chance or that little use, that unknown use of it. Stick in the big ticket items, gold and inflation versus gold and industrial use, silver and inflation as opposed to silver and industrial use. If you're thinking about industrial use, the key levers there are much more like copper, steel, crude oil, things like that.
Absolutely, yeah. Some of the commodities that are, that's their core focus. Well, looking at some of the, so that's silver and gold. Looking at some of the other charts on this page, we're just kind of doing a summary overview here. The oil-gold ratio is another one that I think is important. Effectively, what that is showing, and that is a lever that we have in Hidden Levers. It's basically pricing oil, or asking the question, or answering the question, how many barrels of oil can you buy for an ounce of gold? And so it's kind of leaving the dollar out of the equation, or any other fiat currency out of the equation. And what we see here is that the median ratio over the last 40-plus years is 15. And right now, gold is trading below that. So that means that gold is not buying that many barrels of oil. We're buying something like 12, 13 barrels of oil right now. Now that we are below that median, and we are likely to at some point pop back above it. But if you look at the 2000s, look how long this drifted downward. And we spent almost the entire decade, in fact, below the median before popping back up. So just like with equities or any other investment you're going to value, if you're going to be a quote-unquote value investor here, that's not to say what the time frame is going to be for the next time one of these spikes is going to come. And so I think that would be the issue of looking at it that way. Now, from
looking at that chart, actually, the kind of basic technicals say that this is also just bearish consolidation there. So if you have that double bottom there in the late 2000s, maybe that's where we'll touch, or at least until that 10 barrels per ounce of gold. So I'd wait till then before you think it's a real value.
Right, and then you have that much higher probability of success there. Now, looking in terms of pure fundamentals, gold demand, if we focus principally on the green bars, which would be the beginning of year numbers, that's why they're shaded. They're shaded there, and we see that gold demand has been sort of steadily edging downward. Now, it's not dropping radically from year to year, but given worldwide economic growth over the last 3 to 4 years, and population growth, and all those factors, generally speaking, if gold were behaving like any other commodity, let's say like oil or any agricultural commodity, you'd expect the volume demand, so this isn't based on price, this is actually tons, to actually be rising. Instead, what we're seeing is it's falling, and it's falling even within a context of gold getting cheaper. So if people are willing to buy more gold as gold gets cheaper, you'd think that, oh, okay, that's going to bounce back. But then that brings in the fact that gold is a very significant part of gold demand is investor demand. And so as prices are falling, to a certain extent, maybe investors have been fleeing, and maybe that drops demand as well.
Yeah, it's the nature of things. It's not just gold. Equities can be like that. It's just a snowball effect. That's really it.
Sure. Let's quickly talk
Hollywood actors can be like that.
Yeah, let's quickly talk now about the key drivers, what we see as the key drivers of gold prices. And these two charts, I think, are illustrative. The one at the top right is a chart of the change in gold price versus the change in CPI. And you can see that all the big spikes, generally speaking, in gold are accompanied with a spike in CPI. They're fairly well correlated there. And then by extension, with interest rates too, every time gold, the blue line, jumps, the green line, generally speaking, has jumped as well. And so the big peaks in rates tend to pull gold prices up. And that's simply because the big peaks in rates are, guess what? Those are correlated with the big peaks in inflation. So it all lines up, and it makes it this next chart perhaps more clear. Here on the top left, we're looking at historically, what are some different events in gold price history. Well, if you read a little bit closely, you'll see that most of these are in some way associated with inflation. The oil crisis, the late 70s, this is the Soviet-Afghan invasion, but this is also the time of the hostage crisis. And so you have
in Iran, yeah,
exactly,
which is another oil crisis.
So that's another oil crisis. Then the collapse in gold prices here is because inflation comes down. Inflation returns, as indicated here. This last part of this slow tailing here was when the banks started, some of the central banks started to liquidate their gold positions. But inflation was also very tame, during much of the 90s. Hurricane Katrina, what's that about? Well, again, that's actually about a temporary loss of oil supplies, and oil prices spiked at that point in time briefly as well. So you get that kind of spike. And then this chart ends in 08, but what is this 08 spike? This 08 spike is actually the big oil spike. Again, inflationary. So almost every one of the labels on this chart can be explained in terms of inflation, and that's the real commonality between these events. Now, in terms of max drawdown, I've been talking about it quite a bit, and I just wanted to note that here in various gold eras, we've shown what is the max rise. In some cases, you've had some great bull runs on gold, but we saw that in doing this analysis that gold drops, 44, 48, 47, in that mid-40s% in each of these last three cycles that are complete. The most recent cycle isn't yet complete, so to date, from that September 2011 peak, we're down 35% so far. So if we stay true to form with the previous cycles, we probably have another 10 to 15 percentage points to go. The last point I wanted to make here was that gold volatility is quite a bit higher than some gold investors might realize. It's actually higher than the S&P 500 over the last decade. So not over a short term, but even over a decade.
Yeah, if we can we go back to that table actually? So there's one big difference now. You see there from the early 70s till now, you see a pattern, and maybe as that little gold bug in you is creeping up, and you're saying, oh yeah, we're going to get a big 70 to 600% jump after this 45% drop finishes in gold. And so there's a huge difference now, and that is demographics. From the 70s till now, you have the baby boomers coming, from John Kerry going to Vietnam in the early 70s till John Kerry as a Secretary of State now. And so his next job is he's done, right? So that's a typical baby boomer. They're exiting the system. So that's the big demographic change where this pattern you're seeing breaks down. And so, because probably inflation isn't coming, we're headed into a deflationary era, that pattern will break down. That pattern is basically the ascendance of the boomers as the big stakeholders in the economy, investors and workers, right? So that is ending right this second. 10,000 people retiring every single day in the United States. And that's just the U.S. Europe and Japan have similar things because post-World War II babies now exiting the system. So know that pattern is not going to continue. So let's recap, Praveen.
Yeah, so quick recap in terms of some of those key points. As I just mentioned, inflation is the key driver of gold prices that we see even looking at it on an event basis. A key takeaway for those of you who invest in gold or who have clients who keep on asking about gold is just know that the volatility of gold is greater than that of equities. And so for those investors that see it as a safe haven, it may have certain positive properties, particularly during inflationary events, but it is high volatility. Worldwide demand is dropping, flat to dropping, but it certainly has not been rising the last several years. And the typical gold drawdown indicates that we still have another 10 to 15% to go just to get to that typical gold cycle bottom. All right, now let's look at the macro picture and see how that might affect gold in terms of international and some of the big demand centers.
Okay, in terms of the macro picture, there's two huge buyers of gold in the world, and they happen to be the two largest populations. And so both for investment and for as jewelry, those cultures buy it. In this case, India, let's just compare 2013 when you had a big demise of gold, and now where a lot of people are optimistic about gold rebounding. So let's break that down. 2013, you have a huge tanking in the rupee, along with other BRICS currencies. You did have that. So it was no different. You did have stocks rallying to a record, diverged from China that way, diverged from Brazil that way. So Indian market was solid. Our recovery here in the United States, because we're outsourcers to India, but for the the same things that we're doing well here, technology and then consumption type stuff, their exporters benefited, their software companies benefited. One huge thing is that they are protectionist with their gold market. State-run importers, the trading companies that do that were completely a state apparatus, nothing in private industry. And within all that context in 2013, gold worldwide was down 28%. Okay? So that's the dynamic where gold tanked in 2013. So what are the changes now in India, right? You can see by the chart, you've got a stronger rupee, right? So people might want it more. There's more money inflows into rupee as opposed to gold as a safe harbor of value. That's number one. Number two, the BJP there, the new government that just got elected, is relaxing the importation laws. That means they're privatizing a bit. They're opening it up to private markets. What happens when you open up to private markets? You get more competition. You get lower prices, not higher prices. So more supply, and more supply, static demand means prices go down. Okay, so rupees up and more supply. All these are tending toward gold not rebounding, right? If the second biggest consumer of gold has these things going on. So there's no shortage, whatever shortage there was. And during the shortage is when you had that 28% drop. So now there's no shortage, and that's the idea. Jewelers already are also hesitating to buy, same as during the 2009 to 2011-12. There was a lot of people in housing kind of waiting. They're thinking it's going to keep going down, and so that mentality of holding and not buying for the long term on the back of it going up. So a lot of macro factors in India in 2014, especially with this election, only vie for gold going down more. They're not, there are some articles you read out there about pre-election where folks were saying that this new government would maybe spur gold prices or do something about it because it's such an asset held by Indian investors. But they've only become more sellers of gold since the election. So the prices have gone down since the election. That speaks for itself. Okay, in China, the idea here is what's happening in China, on the macro level. If you came to the War Room a couple of months ago, it was talking about China converting from a big production economy, GDP, by exporting, becoming a consumption economy. So it makes sense that some of that consumption is going to be jewelry, right? So yeah, jewelry demand has been up since over the past year, but investor demand is down double that, about 17% since this time in 2013. And so you can see there now it's just gold is tracking Chinese inflation in the corner, and since that the kind of currency manipulation stopped, or just isn't as bad in China now since late February, early March of this year, you started having even with that, you'd think, okay, our currency doesn't have the integrity that it did, so it's going down against the dollar. We better jump into gold as a safe harbor of value. But they're not. You can see gold going down with that. So it's not like the Chinese investors have jumped into gold to protect against yuan devaluation. Okay, and the middle chart there you can see demand is the gray piece. It's kind of small, that chart, but really it's just about the colors. There's the total demand for gold, and the gray bit is the consumption part. as opposed to investment. And you can see it's really static. It hasn't gone up or down that much. And so for all these reasons, you can see China, the macro picture says, to me, says bearish on gold. Same with India.
Right. And now let's just mention briefly alternatives. Some of you actually recently at the behest of an advisor, we added Bitcoin as an indicator in our data center so that you can actually see that. I'll just briefly point out where you can find it. It's in, one second, we get into here under economic data. We added it under economic data under currencies. You'll find Bitcoin. And there we go, under currencies. Here we are. So down at the bottom under internet, in internet land, since it lives in that nebulous place, there's Bitcoin. But at any rate, we wanted to ask the question, well, what is the impact of Bitcoin and other cryptocurrencies, other alternatives on gold, since many of sort of the boosters of Bitcoin talk about it as being another currency that doesn't have any inflationary properties. It's not like a fiat currency where it can be printed so easily. And in fact, with Bitcoin, there's a fixed cap of 21 million Bitcoin that can never be created per the algorithm. And so the theory is that, according to its boosters, is that it's going to sort of steal market share from other alternative currencies like gold as it becomes more popular and becomes more well known. In terms of the correlation, we see that more recently there seems to have been some correlation, but it's not particularly high. Bitcoin seems to be trading on its own fundamentals. Some of these problems, the big drops in Bitcoin are actually due to scandals in the Bitcoin community. One of the largest Bitcoin firms or brokerages actually went out of business and was found to be fraudulent or incompetent or both. And so, issues like that are specific to Bitcoin seem to still be driving its pricing more than, any correlation to gold in particular. But what's interesting is to look at least right now, let's look at the size of the gold market versus the size of the Bitcoin market. And Bitcoin's actually not that small. This chart at the bottom left makes it look like it's absolutely nothing. It is actually around 7.3 billion. It had gone as high as 10 or 11 billion, actually a little higher than that at one point. But gold is really quite large, 6.5 trillion, the aggregate value of gold in the world. And so, and just for context, the aggregate value of USD issued is also in a similar neighborhood as gold, around 10 trillion. And so, to be a real sort of first-rate currency in the world, perhaps that's how large you need to be. Right now, Bitcoin is 1,000th of that size. So, a long way to go for Bitcoin. Bitcoin could grow 10x, 50x, and have absolutely no impact on the gold market. Even if gold investors were shifting over to it, it's not going to be. If gold crashes, it's not going to be because of Bitcoin. It's too small to matter right now. And the same holds true for the rest of the cryptocurrencies. If you add Bitcoin together with all of its friends, then their gross market cap goes from 7.2 billion to 7.8. So essentially, Bitcoin is 90% or over 90% of the alternative digital currency market. So while it's an interesting development and it is a new opportunity that outside of other issues Bitcoin has, like absolutely insane volatility and other risks, it's not yet gotten to be a real legitimate challenger for gold. All right, Raj, you want to talk about global deflation risk, and that's sort of the big driver that.
Right, and so we've been talking about gold and inflation, but really, and if I was in your position, guys, I would be talking about global deflation risk, left, right, and center. Everything else, to me, we have a scenario library full of excellent analysis, but nothing is as important as this first world deflation risk. We've been talking about this in our Got Income War Room last year when we introduced the deflation scenarios. Now that we're kind of out of the throes of crisis mode and we're kind of in the steady climb up, there is this whole deflation thing, whether it's just simply explained, the big World War II players, right? Japan, Europe, and the United States. All of them, post-World War II, everybody went home and made babies. Biggest generation ever that happened. Now that generation is retiring, or dying, right? They all had babies too, and that's their kids in equal size. In the middle are people like me and Praveen, Gen Xers. A lot of the technology talent actually is Gen Xers, watching the two big demographic components, boomers and millennials, kind of battle it out for who has the economic power, right? And so, but what is happening is, as those boomers retire, they're not producing as much, so that part of GDP goes down, and they're not consuming as much, so that part of GDP goes down. So it's necessarily a recessionary trend. That's just it, and that's happening not only in the United States, but in Europe and in Japan. Right? Japan is the kind of poster child for this. They've had it for the past 20 years, and they haven't been having kids to replace them, and they have pretty awful immigration policies that they don't let people in. So it's most stark there, but there's other things that advance that. We've talked about this a good bit in terms of technology, automation, and commodities not being used as much. Just trends. People aren't driving as much. People don't go. Just the same way. We aren't doing this webinar live and in person. Everything's over the web. Perhaps your meetings are like that. And then that baby bust that's happening in the first world, and not replacing them with new kids. So besides that, though, even today's, besides that, in the short term, you can see our own GDP. We have revised numbers today, where we actually had the first negative numbers in 3 years, right? So post-crisis, what is this big thing that's happening in the world? And it's deflation everywhere, and so that is to me the biggest economic topic that you should be discussing with your clients.
Well,
it isn't as sexy as Russia and Ukraine or some blip in oil prices. But it's a much bigger deal. It's like the Borg, basically.
Right.
Every account.
What I'd add to that, Raj, is that what's interesting, and what has been interesting thus far, is that in this deflationary pulse that we're seeing again, doesn't seem to be affecting equities as much yet anyway, and perhaps that's because we've had so much quantitative easing, and it looks like we may be getting more quantitative easing, in Europe, and so equities have been able to ride that trend to a certain extent, but gold does not seem to be benefiting from the same trend. So, down there in a nutshell, if you believe inflation will return, if that really is your investment thesis, then gold is a place to be, but we can't say that we see any evidence for that. It doesn't look like it's in the cards.
There will be inflation someday. When the Gen Xers are gone, and the really it's the millennial generation, the kids of the boomers, they replace them in terms of having the wallet for the families, buying more houses, all that stuff that people do to spur on an economy at the grassroots level. Once that happens, there definitely will be a reinflation. But until then, as this transfer happens between the baby boomers retiring and the Gen Xers kind of taking over, there just isn't as many of us. I think it's 25 million versus, 30 to 35 million Gen Xers versus 60 million baby boomers, right? So it just isn't enough of us to inherit all that, those jobs and economic output and stuff,
Right. And we got a question on how to use a screener to find investments that might be positively correlated with a deflationary environment or low inflation environment. One way to find those would be to simply select the scenario, and of course we recently did under global scenarios, you'll find the global deflation scenario. So one option there would be to choose a global deflation scenario, and then maybe I'll just look at ETFs to keep my list relatively narrow. But you can look for investments that might do well there, and find a range of different names, and then narrow this down using other criteria. Some of these, of course, are bear market funds and things like that. But what we tend to see are some fixed income funds having potential upside, because of course interest rates tend to come down or tend to be neutral to flat if in fact deflation sets in. So that's just an example of one way to use the tool, and then in a more precise way, if you really want to hone in, you can look for investments that are negatively correlated with CPI as well. So that's another way you can screen. And, actually Wells Fargo off the top looks like the bank that comes up, or the main results that came up there. But so you can screen, on individual levers as well for results that way. And we had another question: are we still deleveraging the financial system? So really the crux of it, and actually this will kind of tie into the recap here, in terms of what's driving the deflationary pulse today, and even if we just look at the U.S., credit standards and lending standards have definitely gotten tighter. So we still don't see the level of lending that we saw during the last boom. But at the same time, there is a fair amount of capital flowing around to companies, if not always to investors, and not investors, if not always to individuals. So it's probably less now the deleveraging aspect. I mean, we've seen home prices start to rise again. Then it is a more general trend, which is based on demographics, based on technology, based on some other forces, just sort of this slow muddling growth that we've got going on that are leading more to deflation, at least that we feel, versus, say, specific financial sector issues. Question on Bitcoin. How is the fixed amount of Bitcoin determined? Good question. So Bitcoin is based on an algorithm that actually it's built into its original setup, that 21 million was selected. And the way that works is that Bitcoin is mined, so to speak. So they set it up to kind of work in a digital sense, very similarly to perhaps the way gold works in real life, where you actually have to mine. Well, with gold, you got to go and find it and mine it out of the ground, right? With Bitcoin, you have to run this algorithm that is actually very difficult, very energy-consuming for a computer to run in order to create a new, what they call, block of Bitcoin. And every time a certain amount of Bitcoin is created, the difficulty of creating the next block, it doubles. That's the way the algorithm is set up, to make it twice as hard each time. So that way, it just keeps on getting exponentially harder to make more Bitcoin until eventually it limits out right around 21 million. So that's how it's fixed. And thus far, it's been around 4 years. And even though there's 7 billion on the table, nobody has cracked the algorithm yet. It's not to say that it's impossible, but it does seem to be unlikely that it'll break in that sense. What has happened is people have had the Bitcoin stolen, because if somebody gets into your computer and finds the secret key that is effectively the identifier for your Bitcoin, they can take it and they can spend it. And that has, in fact, happened. So, any other questions before we recap?
Okay, let's flip.
Looks like we have one more question. Can hidden levers chart the moves in demographics? That's a good takeaway question for us. We don't currently have, let's say, population growth or some of those numbers, but we'll have to get back to you on that. Maybe if we find some of the right indicators, or if you have some ideas about indicators you track. Yeah.
It's a good time to go to the site, Praveen, and go to the suggestion tool, this feedback tool. Let's do that.
So I can drop in here, and anytime, if any of you have ideas, feature requests, things like that, I'll just type it in for you. Hidden levers should.
And this is definitely something that advisors that use hidden levers are doing every day. They ask for little things, they ask for big things, they ask for scenarios. And, we read them all.
Right. So, yeah, that's definitely something we have to go out and look. And if you do have, you can come into the feature request area, and if you do have specific ideas around which levers, or around which indicators, if there's a certain data set that you track and you'd like to see us bring it in, then let us know, and we can do that. But we can certainly do some research there for you as well.
Maybe we should make a macro theme about global deflation. Maybe we will.
All right. Well, let's move into the recap now. Raj?
I think we've pretty much covered it.
Yeah, I think we have, actually. We've hit most of these topics.
Let's not beat a dead horse.
All right. So in terms of use cases, we've touched on some of these already. We've looked at obviously how to get into the data center, and I showed you guys Bitcoin, which is where the rest of the currencies live, and how to get in there. We looked at some scenarios. Let's look briefly, though, at let's go back to scenarios and to scenario library. Actually, I'll mention while I'm here, while I'm in the menus, under scenarios, War Room Webinars is here. We seem to get this question fairly often, and so perhaps that we don't emphasize it enough, but right here in this menu under War Room Webinars, that's where you can find the recordings. The recording both, we're going to record this webinar and post it, but all of our webinars are here under War Room Webinars. So for instance, there's our April 2014 webinar, Guide Income, and you can see all of them by year right in there. We go quickly to the scenario library, and under monetary is currently where we have gold scenarios, which we previously did have gold scenarios. Of course, we had that crash amidst uptrend scenario previously, which will move into historical. But we've updated all of the gold scenarios now, and we have a deflation signal, that's the worst case, where gold is actually signaling the deflation is to come, and you've got the major 40% downside on gold. A drift down to 1K on gold, and then finally the upside rebound scenario. So any of these you can run against a portfolio, as always, or use in stress test reports or otherwise.
Okay, and we'll definitely be adding the that historical scenario now, parking that into history, the 2012-2013 gold crash. So look for that here. In terms of product update, we do have a lot of stuff. We are proud to say that we now support annuities, fixed annuities, variable, and equity index. I'll let you talk about that, Praveen.
We had one more question on the 1K figure. In terms of the data that we used to come up with that, the gold drifting down to 1K, it was looking at that historical average correction. For sure, that was a major point of that analysis. But then the other big point was looking at, and David, you'll appreciate, of course, looking at the technicals, and you can read the charts yourself as well. But yeah, you'll see that there does seem to be some technical indicators showing 1K in terms of support levels. That's what else we factored in there. Now, in terms of product updates, yeah, annuity support for advisor fees. Those are two areas I want to touch on quickly in terms of features that we've added recently, and we'd love to hear your feedback on both of these. I'll first look at, let's say I wanted to add a portfolio. We've made it easier to hit advanced and then to hit annuities. And if you have certain annuities that you've already built out, they'll show up on the list, or you can hit new annuity and you can add one. And we support variable annuities, annuities indexed to a particular index or symbol, and fixed annuities, as in just a garden variety vanilla annuity that just pays X% per year. So you can put any of these into a portfolio and let us know what the fee structure is, the guaranteed return is, and so on. And if you do have a group license, you can share it with others in your group. So that's how you would add an annuity. Actually, I'll choose one just to show how that works. So you select it, the symbol comes in here, you enter in the quantity, which in this case for instruments like fixed income and annuities, it's the actual dollar value. So we keep them at a par price of 1 for these purposes. So that's the annuity support. Definitely take a look if you do use annuities in your practice, and let us know what you think if you have any additional requests there. Within the options features, we actually added a capability here for those of you who use options, who maybe use a call writing strategy or something along those lines. You can add an option here and tell us the expiration and that data. And then there's this concept of repeating the option. So you can tell us, oh, I write this option every month, every quarter, semi-annually, however often you do. And you can tell us what is the premium in terms of what percent of the price of the underlying do you manage to get whenever you write that option. So let's say, hypothetically, I don't know, that it's 2%. So you can create an option like this, and if you're telling us you write it quarterly, then what's going to happen is in scenario modeling then, we are going to also analyze what the positive effect would be of continuing to write that option. So maybe you hold SPY and you write calls against it, and you use that to generate income. Well, now in the stress testing, as you change the time frame, you'll see that income added in to the position. So it's actually going to give you finally a way to show your clients the value of writing those calls. So that's another feature added there.
Should we cover fees? We can support fees now. That's
yeah.
nice.
We've added some basic support for fees. So under the account settings menu, we've added a first quick cut at fees based on advisor feedback. So now what you can do is you can add a fee in here, and it's just a simple percentage. So 1% or 1.25%. We realize full well that your fee structure may be more complex than that, but we wanted to sort of put a stake in the ground and see what kind of feedback you guys would have on this. And so what happens is, let's say that I put in a fee of 1% and I save that. Now if I go into a portfolio, let's just grab a portfolio real quick and let's run a scenario against it. It will actually deduct the fee. So maybe we'll run a China slowdown scenario. This minus 32%, if we see the asterisk there, it says advisory fees of 1% per year included in the projection. So now that is going to be part of the overall projected number.
We weren't sure whether to make that client specific or not. You may, for prospects, you may want to show them without the fees, just so it is, unfettered by your take. So we'll be adding those little nuances as we go.
Right. In terms of the one final area to touch on in terms of new features that we'd encourage you guys to take a look at would be within integrations. If any of you use Black Diamond or Wealth Access, those are two new platforms we've added to our integrations, and so you can now set up to pull in data from Black Diamond or from Wealth Access. And so please reach out to us if you need any help with that, with getting set up there, but we've added those now. And so we're continuing to add integrations and make it easier for you guys to get your data into HiddenLevers.
And if anybody wants an e-money integration, we are desperately trying to work with them. It should be done, but they've been really slow about it. And so it'd be much better coming from you guys than us. Our integration tactics speak for themselves over the past few years. So if you guys have e-money and you do want an e-money integration, then please let them know. Let your voice be heard with them and say, hey, I want my HiddenLevers to coordinate with this, so that force them to call us. Okay, I guess that's about it. Are there any other questions? I guess not. Well, thanks again for your support. We are going into year 5 now of HiddenLevers, and it's come a long way from our last gold scenario to this one, but it was time. And so again, this will be available, this deck, and if you did show up live, you should get CE credit for this as a CFP or SEMA designation. Thanks for being with us, and I hope you had a great holiday. We'll be back again in June. I don't know what the topic will be. It seems like such a boring market right now domestically, actually. We thought we might cover some bigger macro topics like healthcare again, maybe obesity. Let us know what you'd like to hear about. Until then, I'm Raj, and for my colleagues Praveen, Steve, Jonas, and everybody else here at HiddenLevers, thank you, and have a great start to your summer.
Thanks.